Most people who start investing lose money in their first year. Not because the market crashed, not because they had bad luck, but because of one single mistake that almost every beginner makes, and nobody warns them about it. By the end of this video, you will know exactly what that mistake is, why it is so easy to fall into, and the simple system that protects you from it forever. Welcome back to From Zero to Wealthy. If you are new here, this channel is dedicated to teaching you everything about money that school never did. Today we are talking about investing, specifically the mistake that wipes out beginners before they even get started. I have seen this pattern over and over again. Smart people, hardworking people, people who finally decided to take control of their financial future, derailed by this one critical error. Let us get into it. Mistake 1, trying to time the market. The number one investing mistake beginners make is trying to time the market. They wait for the perfect moment to buy. They watch the news. They follow social media. They wait for the market to dip. They wait for certainty. And while they are waiting, the market keeps moving. Here is the brutal truth. Nobody, not professional fund managers, not Wall Street analysts, not billionaire investors, can consistently and accurately predict what the market will do next. Studies show that if you miss just the 10 best trading days of the last 30 years by sitting on the sidelines waiting for the perfect moment, your returns would be cut in half. Cut in half, not by investing in the wrong thing, by simply not being in the market on the right days. And here is the problem. Those best days almost always come right after the worst days, which means the people who panic and sell during a crash are the exact same people who miss the recovery. The fix is simple. Stop trying to time the market, start timing the market, invest consistently every month, regardless of what the news says, regardless of how scary things feel. This strategy is called dollar cost averaging, and it is the single most powerful habit a beginner investor can build. Mistake 2, investing without a plan. The second mistake is investing without a clear plan. Most beginners open a brokerage account, deposit some money, and then ask, okay, now what do I buy? They pick stocks based on what they heard at work. They follow tips from social media influencers. They buy whatever is trending. This is not investing. This is gambling with extra steps. A real investment plan answers 4 questions before you buy a single share. 1. What is my goal? Retirement? A house? Financial independence? 2. What is my timeline? 5 years? 20 years? 40 years? 3. What is my risk tolerance? Can I watch my portfolio drop 30% without panicking and selling? 4. What is my strategy? Index funds? Individual stocks? Real estate investment trusts? Without answers to these 4 questions, every investment decision you make is just a guess. And guessing with your money is how beginners lose it. Mistake 3, chasing hot stocks and trends. The third mistake, and one of the most expensive, is chasing hot stocks and trends. Every few years, a new investment captures the public imagination. Everyone is talking about it. Your friends are making money on it. Social media is full of success stories. So you jump in, and almost every time, you jump in at the peak. Because by the time regular people are talking about an investment on social media and at dinner parties, the smart money has already bought in, made its gains, and is quietly selling to you. This is called buying high and selling low, the exact opposite of what builds wealth. The solution is boring, boringly effective. Invest in broad market index funds, funds that own hundreds or thousands of companies at once. No picking, no guessing, no trends. Just steady participation in the overall growth of the economy over time. Warren Buffett, the greatest investor in history, has said repeatedly that a simple low-cost S&P 500 index fund will outperform the vast majority of professional fund managers over the long term. If it is good enough for Warren Buffett's advice, it is good enough for a beginner. Mistake 4, panic selling during a market drop. The fourth mistake is panic selling when the market drops. And the market will drop. It always does. Corrections of 10% happen roughly every year. Bear markets of 20% or more happen every few years. Crashes of 30% or more have happened multiple times in history, And every single time the market has recovered and gone on to reach new all-time highs. Every single time. But beginners do not know this. So when they see their portfolio down 20%, they panic. They feel sick. They think they are losing everything. And they sell. They lock in their losses, and then they watch as the market recovers without them. The investors who became wealthy are not the ones who predicted every crash. They are the ones who stayed calm, kept investing, and let time do the work. Your portfolio dropping on paper is not a loss. It only becomes a loss the moment you sell. Stay invested, stay consistent, and let compound growth do what it has always done. Mistake 5. Waiting until you have enough money to start. The fifth and final mistake is waiting. Waiting until you have enough money. Waiting until you understand everything perfectly. Waiting until the timing feels right. There is no perfect time. There is no minimum amount. Many of the best investment platforms today allow you to start with as little as $1. The cost of waiting is not zero. It is enormous. Every month you delay is a month of compound growth you can never recover. A person who invests $100 a month starting at age 22 will retire with more money than a person who invests $500 a month starting at age 32. Not because they invested more, because they started earlier. The best investment decision you can make today is simply to begin. Open the account. Make the first deposit. Start small if you have to, but start. Outrow, 5 mistakes, timing the market, investing without a plan, chasing trends, panic selling, and waiting to start. Avoid these 5, and you are already ahead of 95% of beginner investors. Investing is not complicated, but it requires patience, consistency, and the discipline to ignore the noise. Build your plan, stick to it, and trust the process. If this video helped you see investing differently, please hit like, share it with someone who needs to hear this, and subscribe to From Zero to Wealthy for more weekly content on building real lasting wealth. I will see you in the next one.